This American bank appeared to be doing well. In fact, in its 2022 balance sheet, we have customer deposits, liabilities, and assets. It seemed like a bank that was actually being managed precisely. The mistake that SVB made was not covering the interest rate risks in its portfolio. To put it simply, what they did was buy mortgage-backed securities at the peak in the hope that interest rates would remain low for longer. In other words, the central bank would not have the courage to raise interest rates so high. Most banks rely on deposits. All this would not have happened if the bank's customers had not gone to the bank counter and said, "I want to withdraw all the money, all the liquidity in my account." Obviously, the bank does not have all the depositors' money. In order to earn money, the bank will need to lend that money, make it circulate, and have a return higher than the return it pays for that liquidity. This is what brought out the major liquidity problems. Prior to this, it happened that last Wednesday SVB had to declare the sale of $21 billion of so-called AFS, or deposits available for sale. That is, everything the bank can sell quickly. This move generated panic. There were accounts of companies that were financed by venture capital, and some very famous venture capital firms also said, "Attention, there could be liquidity problems. Go and withdraw your money." The word has spread, and this round of fast-paced information has created these problems. This is not a debt crisis. This is not a financial crisis. It is actually a crisis of the contextual situation we are experiencing due to the destruction of central banks' liquidity. Now in the United States, American authorities are trying to salvage what can be salvaged, especially to prevent a chain reaction. Because there has been a run on the bank's counters, especially for the big ones, those that, let's say, due to American regulation, must have a high LCR, that is liquidity coverage ratio. It is extremely important and extremely restricted in Europe. Many think that what is happening in the United States could happen in Europe. Perhaps for cooperative banks, small ones, but in Europe, the situation is different. Regulations are restrictive, which in situations like this are salvation. That is why in Europe, what is happening in America cannot occur, because in the United States, all banks with assets less than $250 billion do not comply with the LCR regulations. In Europe with Basel IUA, so-called SIFI or global systemically important financial institutions, are required to have a high-quality liquid assets and to have an LCR equal to 100%. So basically, banks must have the ability to cover their total net cash flows for a stress period of at least 30 days. In America, banks that are not part of the SIFI fall under an LCR of 8%. In America, this situation applies to all banks with assets below $150 billion, exempting them from this regulation, and that is why this situation is being created. And that is why we observe in the bond market that the yields of 2-year government bonds are falling because flows are shifting. In other words, everyone who had liquidity in their bank accounts said to themselves, "I don't want to risk keeping all this liquidity with my bank, so I'll buy government bonds." Thus, reducing risk and even increasing returns by buying government bonds. Now that they are buying bonds, yields are falling. On the daily chart of US government bonds, on March 9th, it was minus 4%, on March 10th, it was minus 5.77%, and on March 13th, it was minus 11%. Essentially, yields have given up all the gains they had made since the beginning of February. Moreover, the situation in Europe is similar. German bonds have gone from 2.7% to 2.2% over 10 years, burning 50 basis points. Everything that is happening is not a black swan event, but it is the destruction of money. An economic system in which liquidity is pumped cannot last forever. In fact, in 2022, investors realized that markets were not only going in one direction. 2023 is the consequence and result of a year, 2022, of restrictive monetary policies after 2 years of extremely loose monetary policies. This is the situation, this lack of liquidity. There was mismanagement in SVB. But it is precisely when liquidity, money, is scarce that problems arise, and those who did not manage well, who used too much leverage, will be exposed. These companies fail due to their use of leverage. Let's look at the bank's table. There was a 100% increase between 2020 and 2021, precisely when the central bank pumped liquidity. The venture capital activity in this bank went from 167 billion to 330, an increase of practically 100%. The bank bought about 80 billion in mortgage-backed securities. Now the problem is that about 95% of these MBS had a duration of over 10 years, with an average yield slightly below 2%. In 2022, the Fed began raising rates, creating a loss on the fair value of these positions. Not only do fixed income prices fall when the Fed starts to raise rates, but yields increase and fixed income decreases. The bank was able to hide liquidity problems as long as depositors kept their deposits with it because the securities paid more than they cost. But when depositors began to withdraw their money, everything collapsed. Now, authorities say that all customers of this bank, and of banks that will have this problem, will have their accounts guaranteed. So, if you have $200,000 or $1 million in your account, it will be returned to you. This is not a bailout as such because they are not saving the bank, they are saving the bank's customers. The situation that is occurring now is not favorable for the US dollar because if flows are moving to bond securities, liquidity is leaving. We may see further weakness in the US dollar. Goldman Sachs, due to the liquidity crisis in the banking sector, states that the Fed should not raise rates next week during the next FOMC. So, last week we counted 50 basis points after Powell's testimony, a few days away with a market that now even wants a pause in the central bank's rate hikes.
While you've reached the end of the video, if you are interested in learning more about similar topics, here you will find other really interesting videos from the channel. Thanks for watching this video. Click on the like button if you enjoyed it, and do not forget to subscribe in case you didn't. See you on the next one.